SoftBank has quietly done something that will make investors and strategists pause and reevaluate the picture of who is building and who is banking on the artificial intelligence revolution. In October, SoftBank sold its entire stake in NVIDIA, a position the company disclosed had generated roughly $5.8 billion in proceeds. This wasn't a small trimming of exposure, it was a full divestment of a holding that, until very recently, many assumed belonged in the long-term strategic locker of any firm betting on AI infrastructure. The mechanics are worth stating plainly. SoftBank's disclosures indicate the sale comprised tens of millions of shares, executed across October at an average price that, by some calculations, was below recent trading levels. The headline figure reported was about $5.8 billion in cash realized from the sale. That detail matters because it tells us two things at once. SoftBank was willing to crystallize a very large sum from a company seen by many as the central supplier of the AI age, and it executed that crystallization at prices that, depending on the day you look at, might later be judged conservative or ill-timed. Why would SoftBank do this? The answer, in public-facing terms at least, is straightforward: capital redeployment. Company statements and reporting show the cash will be funneled back into AI investments, most notably expanded commitments to OpenAI and other ventures central to SoftBank's pivot toward owning pieces of the actual application layer of AI, not just suppliers of compute. SoftBank's leadership frames the move as doubling down on strategic, higher-return bets in AI software and services, rather than holding through exposures in the semiconductor supply chain. That explanation is credible, yet it invites a deeper question. Is this allocation decision based on conviction about where value will accrue in the coming decade, or is it a tactical reshuffling driven by near-term liquidity needs and balance sheet optics? Markets reacted the way they often do when a major, reputable investor exits a marquee name, with skepticism and short-term repricing. NVIDIA's shares slipped in the immediate aftermath, and commentary from analysts framed the sale as feeding existing worries about potential overheating in AI valuations. But it's important to separate signal from noise. A single large sale can depress price simply through supply dynamics. It does not, by itself, prove that the underlying business model for NVIDIA is broken. NVIDIA's fundamentals, its GPU, leadership, software ecosystem, and engineering moat remain intact. What may be changing is the narrative about where the biggest returns will be captured: hardware, or the emergent companies and platforms that run on that hardware. To understand the significance of this pivot, we need to consider SoftBank's playbook under Masayoshi Son. For years, SoftBank has been both an aggressive venture allocator and a high-variance portfolio manager, willing to place enormous bets on early-stage tech with the expectation that a few winners will justify many losses. That approach has produced spectacular hits and painful misses. Selling a high-profile holding like NVIDIA and redirecting proceeds into companies such as OpenAI signals, in plain terms, that SoftBank sees more asymmetric upside in owning slices of companies that will monetize AI through software, products, and services than in passively holding on to a hardware supplier, however central it may be. This is not merely portfolio housekeeping, it's a statement of where SoftBank believes the profit pools will be. What does this mean for different audiences? For long-term investors in NVIDIA, the answer is nuance. The company still controls a dominant position in AI compute. Its architecture and developer ecosystem are real competitive advantages. But if capital shifts its scale from chip makers into software platforms and AI service providers, we may see a re-rating of companies depending on their place in the stack. For startups and entrepreneurs, the message is clearer. The firms building applications, services, and models that sit on top of compute are now more likely to attract the kind of strategic capital that can accelerate growth. For policymakers and industry watchers, SoftBank's move underscores how capital flows can shape not only markets, but the direction of technological development. There's also the risk framing dimension. Some commentators are already using this sale to argue that the AI market is forming a bubble. That is a tenuous leap. Bubbles are about broad speculation detached from fundamentals. What we are seeing here, at least so far, is a large investor reallocating capital within the same broad ecosystem, from hardware to applications. That can feel like a flight from hardware risk to software risk, but it's not the same as a market-wide collapse in demand. Investors should watch for follow-through, selling across unrelated names, and for credit stresses in leveraged plays. Absent those, this looks more like strategic repositioning than a collapse. Finally, the strategic lesson is this: leadership in technology does not guarantee forever ownership of value. Companies that build platforms often create the conditions for adjacent layers to capture profits. For NVIDIA, the opportunity remains to capture value through continued innovation in architectures, software stacks, and partnerships. For SoftBank, The wager is that ownership of applied AI, the companies that will monetize models, will outpace pure-play hardware in returns. Whether that bet pays off will be one of the most important investment stories to follow this year. Watch not only the headlines about sales and stock prices, but where the capital lands and how those recipients deploy it to build defensible, revenue-generating moats. In the next few weeks, keep an eye on three things: how NVIDIA's stock trades relative to its own earnings and guidance, whether other large holders follow suit, and what deals or funding rounds SoftBank announces with the proceeds. Each of those will reveal whether this was a momentary rebalancing or the opening move in a broader structural shift in where investors believe AI value will concentrate. The scene has changed. The players are the same. The rules, for now, are still being written.